Hello and welcome back to Patrick Boyle on Finance. In today's video we're going to learn about negative interest rates, which have been all over the news recently. I'm going to cover the mechanics of how negative interest rates work. We'll discuss where negative interest rates have been implemented and how that has worked out. We'll learn how savers and borrowers are impacted and what are the side effects of negative rates. If you stay tuned to the end of the video, I'll tell you the 6 ways University of Chicago finance professor John Cochrane says you can effectively earn an interest rate of 0 even if paper currency along with money in the bank is earning a negative interest rate. Countries all around the world are taking all sorts of extreme measures to keep their economies afloat during the coronavirus pandemic. I put up a video a few weeks ago on which country is spending the most in terms of GDP in these efforts. I'll put a link to that above. The US Federal Reserve has already cut the Fed funds rate twice in 2020, and there's debate amongst some about whether rates should be lowered again. Right now, the US Fed funds target rate is 0% to 0.25%. If the Fed lowered rates again to help the US economy, rates would drop below 0. Negative interest rates are controversial, but countries such as Sweden, Switzerland, Denmark and Japan have already implemented this approach. Albert Einstein once called compound interest the 8th wonder of the world, adding, "He who understands it earns it, he who doesn't pays it." But at negative interest rates, money saved today would instead be worth less every day going forward. To better understand negative interest rates, it's helpful to start by looking at the historical background. During the global financial crisis of 2007 to 2009, central banks decided to lower interest rates as close to 0 as possible. Economies around the world began to recover, but at only a slow pace, so the central banks chose to keep rates low in the hope that individuals and businesses would be encouraged to borrow more, increase spending, stimulate economic activity and create jobs. At 0%, borrowing and spending remained sluggish, and nations were still worried about deflation, so central banks introduced an arsenal of unconventional monetary policy measures in order to stimulate real growth and prevent deflation. They included central bank purchases of increasingly risky assets, forward guidance and negative interest rates. So why are people talking about negative interest rates right now? Well, central banks typically operate under one of 2 types of mandate. A hierarchical mandate, which makes price stability the primary objective for monetary policy, subordinating all other potential objectives, or what we call a dual mandate, which recognizes 2 objectives, price stability and full employment, and puts them on an equal footing. You can look up the inflation target of your country's central bank online, but essentially every country has one. Most developed countries at present have an inflation target of around 2%. In emerging markets, you see a range of targets from 3% to as high as 9%. Inflation is measured by the Consumer Price Index. The annual inflation rate for the United States is 0.3% for the 12 months ended April 2020, as compared to 1.5% previously, according to the US Labor Department data, which was published in May 2020. Similarly, in the UK, CPI has fallen to 0.8%, so in both cases well shy of the 2%. While this just means that the cost of living is rising more slowly, if inflation remains low for too long, employers start factoring it into pay reviews, which can dampen consumer confidence and spending. Economists fear deflation because falling prices leads consumers to defer spending and wait for lower prices. In addition, they can become unwilling to borrow, as the loan will have to be repaid in dollars that are worth more than the dollars that they borrowed. Companies respond to falling prices by slowing down their production, which leads to layoffs and salary reductions, which then leads to further spending reductions by consumers. Okay, so how do central banks implement negative interest rates? Negative interest rates impose penalties on those who deposit funds in certain types of accounts. For most of the nations that began using negative interest rate policies, the affected accounts were those held by commercial banks at central banks. Just like you and I deposit money in banks, commercial banks deposit money in central banks. This is done for a few reasons, one of which is check clearing purposes, and the other reason is to satisfy central bank reserve requirements. By setting negative interest rates on these deposits, commercial banks are discouraged from keeping excess funds in these accounts and are thus encouraged to lend. Among the first central banks to pursue negative interest rate policies were Denmark's National Bank, which started in July 2012, the ECB, which started in June 2014, the Swiss National Bank and the Swedish Riksbank, which followed in early 2015. For Switzerland, Denmark and Sweden, the rationale for lowering rates below zero had more to do with their exchange rates than credit creation. The moves were defensive and intended to prevent their currencies from appreciating in response to the ECB's interest rate policy. Let's work through an example in order to understand how negative interest rates work on retail bank deposits. If you assume that a bank customer deposited $1,000 in an ordinary bank account, central banks then regulate what a bank can do with that money. One of the central bank tools is the reserve requirement, which requires banks to hold a certain percentage of their deposits in highly liquid, low-yield forms, such as cash in the bank vault and deposits at the central bank. Only the remainder can be lent out. So if, for example, the reserve requirement was 10%, the retail bank would need to hold $100 of the $1,000 deposit, either in cash or at the central bank, and it could lend the remaining $900. In times of economic uncertainty, the bank may choose to hold more than the minimum, reducing the amount it lends to less than $900. Maybe in our example we can say to $800. Now, in order to encourage lending, the central bank might impose a negative interest rate on these voluntarily held excess reserves. So in our example, the extra $100. So the initial $100 that they're required to hold, they're not being charged this penalty on. It's only the extra that they're choosing to hold in reserve. To avoid this penalty, the bank would then have to keep excess reserves at a minimum. It could lend the excess reserves, which is the goal of the central bank. So how would negative rates affect savings? Well, savers have already seen their returns dwindle in recent years due to the very low interest rates we've been seeing. In countries with negative interest rates, commercial banks have passed them on to big companies who have a lot of cash that they need to store at the bank. The evidence suggests, though, that it's quite difficult to pass the negative rates onto ordinary savers. In Sweden, they just concluded 5 years of negative interest rates, but banks did not tend to pass these losses on to savers. Swiss banks only impose negative rates on deposits of more than 2 million Swiss francs, which is roughly around $2 million US. In Germany, where some banks impose charges on deposits of more than 100,000 euros, some people have started keeping their money in safes. Germany's largest safe manufacturer has seen a 1/3 increase in sales since the deposit rate at the ECB went below zero. So how might negative interest rates affect borrowers? Well, negative rate mortgages already do exist. Last year, a Danish bank announced that it would effectively pay borrowers 0.5% a year to take out a 10-year loan. It's worth noting that this was only possible because of the nature of the Danish mortgage market, where Danish banks act as middlemen between potential borrowers and investors. In Denmark, the banks don't take the hit, investors do, and banks are just charging a pass-through fee. So they actually ended up making money out of this negative interest rate mortgage. Now, when UK interest rates were cut to 0.5% in March 2009, some borrowers thought they could be in line for a payment as they had mortgages that were supposed to track 1% below the Bank of England base rate. Their hopes were quickly dashed when financial regulators described interest payments as a one-way obligation on the borrower. It's similarly unlikely that American borrowers would be paid to take out mortgages simply because of the structure of the loan agreements that Americans enter into with their banks and the nature of the US banking system. Okay, so what are the side effects of negative interest rates? There are many side effects associated with negative interest rates. For example, insurance companies and pension funds struggle in such an environment to meet their commitments due to the ultra-low returns on the share of assets that they're required to keep in investment-grade bonds. In addition, low interest rates encourage more risk-taking and increased debt, which drives up the prices of financial assets, such as homes and commercial real estate. Negative interest rates can hurt bank profitability and end up reducing lending and credit creation. Finally, low or negative interest rates force those with a very low risk tolerance into riskier investments in order to simply maintain their wealth. In Sweden, where they recently ended a 5-year experiment with negative interest rates, it was argued that when rates turn negative, it can contribute to a sense that markets are stepping through the looking glass. The strangeness of the financial system makes people feel so anxious that it undermines the benefit of cheaper loans. It's worth noting that people might behave differently than expected with very low or negative interest rates. Those who are by their nature inclined to save more than others don't suddenly rush out, borrow money and buy a Lamborghini. They instead notice that their savings are no longer growing, and they respond by reducing their spending and saving even more in order to meet their financial goals. You only need to read the German popular press right now to see how unpopular negative rates are with the public. In fact, the risk is that negative rates simply fuel fears among investors that something is deeply wrong and permanently wrong. So how can you avoid being charged negative rates by your financial institution? University of Chicago finance professor John Cochrane gave a list of 6 ways to effectively earn an interest rate of 0, even if paper currency along with money in the bank is earning a negative interest rate. Number 1 was prepay taxes. The IRS allows you to pay as much as you want now against future taxes. Number 2 was buy gift cards from businesses. There's even an active secondary market in them online, so you could even put a large amount into a gift card and possibly sell it on to someone else. Number 3 was buy other stored value cards like Subway cards, postage stamps, and so on. And he points out that Subway cards are anonymous, so you can resell them. Number 4 was prepay your utility bills. You could pay in advance a few years of, we'll say, your gas bill, your electric bill, your phone bill, and so on. And number 5 was prepay your rent or mortgage. Number 6 was that businesses can prepay suppliers and leases, and they could even possibly prepay wages or at least pre-fund benefits that workers must stay employed in order to earn. Thanks for watching. Don't forget to hit the like and subscribe buttons to see more finance content like this. See you later. Bye.